Well, welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report. It's great to be back. We're almost there. Christmas is just around the corner. And boy, do I have some gifts for this week's beers. Let's crack it. This week's beers is brought to you by lovers of cash and lovers of beer, which includes our analyst team. It's a big one. It includes our analyst team because they've sweated over a new stock that we've initiated this week. Exciting stuff. And this week I want to go through, some of the pitfalls or some of the swings and roundabouts we went through on our latest travails analysing, the new stock that we've tipped. So basically a company, what is it? It's made up of assets. And what we're trying to do here is work out what each asset might be worth. And that's a factor mainly made up of the income it can produce in the future. Not always, but mainly. So there's a reason some stocks are under the radar, and that's that. They're off. They can be their own worst enemies. They don't make it easy on themselves because their reporting is not up to scratch. And it requires a lot more concentration and, dare I say it, perspiration. But this provides us with opportunities, and that's what we love. So when the stock's written off by many as too hard, that's when we step in. So this week's tip, the reason why I mention that is this week's tip was a doozy. Basically, it was a classic case of a company making it too hard for investors to understand. To give you an idea, their divisional alignment was all confused. So sometimes divisions consisted of one area, but then they were merged into other areas. So there was no like for like. And on the time basis, they were comparing 2 and 5 year time horizons, within 2 pages of each other, with different divisions whose, as I said, the definitions weren't consistent. So this is just one presentation, and then you have to kind of reconcile those numbers with prior presentations in order to get, so what are these assets really producing? What can they deliver? So, and when there is inconsistency and analysts or many people write it off, that means that basically the company's not getting the recognition it deserves. So it's not valued correctly. And this one in particular, our analysis showed that it had gone through a significant transformation. So that's why we brought it to subscribers. And it's only after we've put into a lot of work that we brought it to subscribers to understand how this transformation translates to future income. So because that's what basically a share price is. It's a summation of estimated future cash flows discounted at today's value. There you go. It's simple. But people forgot it, didn't they? They forgot it when we're in this zero sort of interest rate environment, and they thought, we'll just go for growth. Doesn't matter what the cost. Doesn't matter how far out the future cash flows are. But now that interest rates are rising, the screws are on, and the importance of investing discipline has returned. So this means not paying too much for those projected cash flows. So what about valuation in this case? Well, it's an engineering company, and they tend to trade on relatively low multiples because they're capital intensive, and they don't produce above much, or typically don't produce above market growth. This stock is cheap even for an engineering company. It's trading on a forecast PE multiple in the mid-single digits, dividend yield of 6%, which we forecast to go to 7%. We're talking deep value here, people. That deserves a swig. Because let me come to the kicker. The kicker that the company's delivering 20% plus earnings growth because it's got an edge on its competitors. It's got superior IP or intellectual property, which means it can charge more. So there is cyclical risk. But the IP factor has delivered for us in the past. I mean, we've made 400% plus returns after buying and selling contractors, including SRG, GR Engineering, Southern Cross Electrical, Maca, there to name a few. The key is that these stocks are cyclical, so they're not set and forget. So you have to keep looking at them and keep analysing them consistently, and that's where we also come in. It's enough to make you grab a cash rules everything around me beer. That's a long beer. This week we cover a number of med techs, 3 in fact, in detail, which we have buys on. 2 of them have big regulatory findings coming out before Christmas. That's right, before Christmas, or it's slated to be before Christmas. So give yourself an early Christmas present. Find out which ones they are. Put them under the tree. The bigger point is that you should only own these type of high risk or high beta stocks, if you will, if you've invested in some solid dividend paying performers. If you've got them in your portfolio, I would say that even in this case, blue chips can disappoint. I mean, next week we're going to be covering Downer. I mean, diversification is important even when it comes to these so-called blue chips. So that, we mean owning at least 15 stocks. So next week we'll be covering Downer, which has fallen out of bed due to a combination of accounting irregularities and weather. So we'll run the numbers to work out whether there's value in our blue chip. What's coming up? Well, Downer. Let's get on to an upper. We're drilling down on the energy sector like never before, where we see all sorts of complicated maneuverings in the form of M&A, and yes, that means opportunities. We've also got a portfolio rundown, and our portfolio managers deliver share trading tips, which are must-read stuff. The beer. Let's get on to cash rules, everything around me. Well, what happens when you finish the cash? You get another one. Let's see. Double dry hopped pale ale from a Brisbane-based brewer, Range Brewing, I see. Well, it's not bad, as you can probably have told. The real deal, that's what we are under the radar. And the rest, find out about next week. Here's to Bees with Rich. Get your Christmas activities started.